Okay, welcome to my YouTube channel. And again, anytime during the week, you can listen to my my national syndicated show. It's on a sure station near you. If not, you can listen to it on my YouTube channel. Okay, I'm going to explain to you where the economy is at. People keep asking, what shape is the economy in? What's going to happen? Are we going to have a big crash? What's going on? I'm going to answer that question to you right now. Okay. We've been told that the economy prior to the pandemic, okay, was fantastic. Best economy ever. Okay? That's what we were told. Well, that's not true. And now we're being told that the growth of the economy is coming back. Going to be gangbusters according to Larry Kudlow. That's not true either. I'm just going to show you something quickly. Okay, let me put up your trend of your market. There's the trend of the market right there. See it? Okay, but there's a problem in here. What do you see? See how nice and tight that is? That's when the market is strong. Now you're seeing the trend is breaking down. See this? That means the trend's breaking down. Even worse, look at this. I'll put it in a different color. If I take from here to here, from here, look at that trend. Oh my God, that's heading for a hell of a crash. This is called clusters. See how wide the cluster is apart here compared to here? And look at this. That means there's no consensus. This is really bad, okay? Now let me explain what's bad and what they're telling us. Right now, they're telling us the economy is coming back nicely, and it's not true. Here's why. First of all, if you take, let me get rid of this. If you look at let me remove this here. Okay, so let's take the economy. Right now, we have our economy, the size, we're in a debt to $27 trillion. Okay? And and the size of our economy is only $19 trillion. That's really bad. Okay? That means we owe more than the size of our economy. That's very negative, very bad. In fact, we owe more than that. If you add another $7 trillion, because that's what the government owes us, they stole money from us, the Congress, and our Social Security and Medicare, add another $7 trillion. The real debt is 34 trillion, but it's even worse than that. Why? Because let's add all the mortgages that people own, 16 trillion. Add that, okay? So that's 50 trillion. That's the real debt. Now, even if you don't want to add all this in, we're still in bad shape at 27 trillion. Why is that? Well, because our economy is only 19 trillion. In other words, we are spending, the reason we are only at 19 trillion and our debt's 27 trillion, because we are spending 6 trillion a year and we're taking in revenue 3 trillion a year. So we're spending 100% more than we take in. Wait a minute, I thought they just told us before the pandemic it was the best economy ever. Well, that's a bold-faced lie. You can see it right there. Okay. Now, when the stock market collapsed, when the market collapsed right here and dropped 33% or 38%, remember, housing dropped 40%. So in other words, the stock market dropped 38% and home sales dropped 40%. Now just remember that number. And now remember, they're telling us that the economy was fantastic before this all happened. Well, that's not true, because they had to bail out the banks, okay, in 2019, September 2019. They had to print, the Federal Reserve had to print $75 billion. I think it was September 16th, not sure. And they had to dump it into the credit markets. Now, what is a credit market? Credit market is just where corporations, including banks, go, and governments, our government goes in and borrow money from investors. And investors in return get a bond. and the bond would be 5 years, 10 years, and then they get paid back. Well, the credit markets, the short-term part of the credit market in 2019 blew up, okay, called repos. What is that? That means at night banks get together and they help each other. If I spend $5 trillion more than I took in during the day, I can't open up my bank the next morning unless they're even. So I would borrow from you, my friend, the other banker, and I'd pay you 1.5% interest, and I'd pay you back in the morning. Well, something happened on September, we used the 16th. What happened is the banks, there's no money. One bank couldn't help out another bank. In 2008, when that happened, remember, the banking lending froze up, and we went into immediate crash. The Federal Reserve panicked in 2019, September, printed $75 billion, came in and was saved the day so the banks could loan to each other. But that wasn't the end of it. What they didn't want to tell you is they didn't want to tell you that in the meantime, they kept printing money. They've been printing $215 billion a month ever since September a year ago, every month, to keep putting into the credit markets for the repos so it doesn't happen again. But even worse than that, the corporations, now remember, we've gone through, from this point here, 2008, remember the market's never improved. Our economy never improved. Our economy was propped up. We never had a recovery, but a propping up. And remember how we do that, through stock buybacks. And simply, if you didn't hear this before, I'll just tell it for the new listeners. What a stock buyback is this. It's really simple. If I have 10 million shares outstanding, my company, and my earnings are at 8%, and my stock is at $30, what does that mean? That means I got enough earnings at 8%. I can spread my earnings. I got enough earnings to spread over 10 million shares, so my stock will go up, let's say, $5. So my stock will go up. But what happened after the market crashed? Nobody had money to spend, so companies weren't making profits. They weren't making earnings. So what did they do? They replaced the earnings with stock buybacks. They created a trick. They print all the money and give it to the corporation CEOs for free. So let's say the earnings came in at 6%. Well, guess what? 6% will not spread over evenly over 10 million shares. The earnings are too little. So the stock price would go down, let's say $5. Well, they didn't want that to happen. So by printing money, giving it to the CEOs, the CEO go in and it would reduce the amount of shares. He reduced the amount of shares from 10 million, okay, down to like 9 million. Now it works. So with earnings of 6%, the stock price would go up 5%. See the difference? That's how it works. Next quarter came, same thing. Earnings dropped to 5% because nobody had any money, no profits. So how are they going to move the stock market up? Same thing. They go and reduce the 9 million shares down to 8 million. So 5 spread over 8 million is easy to do, and that would push the price back up $5. So all these stock prices are now way overpriced, unbelievably overvalued because of all this trickery right here, which once used to be a felony. So now what happened in 2000 and right when the pandemic hit, we were already the market was ready to crash anyways because the credit markets were in deep trouble. It just happened to be the pandemic hit at the same time the market was already going to crash on its own. So it dropped 38%, the stock market, right? And housing, which of course the backbone of our economy, collapsed. Sales collapsed by 40%. Sales dropped by 40%. Now everybody panicked. The Federal Reserve panicked. So what did they do? They turned around and immediately the bank's now in real serious trouble because 32% of the people that have mortgages weren't making their payments. So what they did is they turned around, the Federal Reserve printed $2 trillion immediately and went in and purchased the mortgages from the banks to bail them out. That's 20%. 20% of the entire $10 trillion mortgage market. What are you, nuts? That's insane. Then they turned around and gave a forbearance. People didn't have to make their payment for a year. That means 4 million people were not making payments to the banks. Now think about this. In 2008, when we had the crash, 8 million people were in forbearance. This is half, 4 million. Just to put in perspective how bad our economy is, if 8 million people in 2008 couldn't make their payments, We got half of that can't make their payments now in an economy that they're saying is terrific. What a bold-faced lie that is. Isn't that amazing? Okay. So they turned around and they dropped interest rates to 2.5%, and now the banks are giving forgiveness, and we got about half the people. I got 4 million people out there. They're doing that, and that means the bank's cash is drying up every day. So that is why they're printing money every day. Okay, the Federal Reserve, they're printing $608 million every hour to keep going in and propping up the banks by buying the corporate debt. Because all these corporations that borrowed all this money to push their stocks up through stock buybacks, all that money is due, and they can't they can't pay it. So the banks are going in, propping up the banks by buying the corporate debt. Okay, they're printing $215 billion a month to prop up the banks for the overnight loans to each other, and then they're still doing. They're printing $26 billion an hour and purchasing treasuries to make sure interest rates stay at zero. Does that sound like a real strong economy? I don't think so. So let me just draw in here so this will be stuck in your mind. How's the economy look compared to the way it's supposed to look? So we're in deep, deep trouble right here. So what's going on is this. Now they're telling us, now think about this. Every day, we're on a yearly basis now, we are printing, okay? We are spending $6 trillion a year, but we're only taking in $3 million a year. That's a deficit. That is a dangerous deficit. So the bottom line is that wages have not been going up. The wages have only been going up for the working poor, people who work in service industry. But that doesn't help the overall economy. It helps them. What helps the overall economy if wages are going up in the middle class? We have your manufacturing, your drilling, your mining, your construction, right? But none of those wages have been going up because it's those wages we need so that people, the middle class, can go in and start businesses. Because remember, it's new business startups that provide 72% of our jobs. Well, those are all gone now because we haven't been able to go in, and companies aren't taking money and plowing it back into the company for new equipment so that we can give these people raises, the middle class, so they can go start their businesses. No, that money has been shifted away to the CEO where he takes it and he does a stock buyback, so the shares that he owns, his partners on Wall Street and the biggest shareholders make a fortune while Main Street gets screwed. That's the major problem that we have today. Because remember, they tell us how the stock market's doing terrific for everybody, right? We hear every day how the stock market's doing terrific. Trump, unfortunately, tied himself to the stock market. He listened to Larry Kudlow, which is a big mistake. He kept saying to the president, just keep pounding the stock market. You're the one, the reason why it's going up. Tell everybody you're the one why it's going up. Now, we know the reason why it was going up because of stock buybacks, not because the economy was doing good. But now that's all falling apart. The stock market's falling apart. The only way they can keep pushing the market up right now, okay, again, is by pumping up. Remember those 5 stocks, those big FANG stocks? Since 2013, it's those 5 stocks, 6 stocks that kept this whole market going. Those stocks are now collapsing, okay? And so is our stock market. So our market's collapsing because the big FANG stocks now are dropping like this. That's why we're already down here already. See, like this, we're coming back down. So we are in a dangerous position here. So it's just going to get worse. It's not going to get any better. So that's where we are. Now, what's going to happen to the stock market? We're going to have a major crash, okay? The only thing that's holding up now is they're going to start the story. Do you remember back in 2014 when the market dropped in 2014? Okay, I mean 2019 right here, 18, 19, when the market dropped in here. How did they get the market to go back up? Telling everybody that any minute now we're going to have China was going to sign a trade agreement. Remember that? We had this big drop right here. That was about a 20% drop, but they pushed it up saying China, 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 China. Well, now the market crashed again. And now they're pushing it up saying any day now there's going to be a vaccine. There's going to be a vaccine. Well, that's not going to happen. We're not going to have a vaccine in time, believe me, all right? So the best thing to do is to stay in the market. You got to know, as long as they're pushing it up, stay in it. You just got to know when to get out of it. That's all, okay? And that's pretty easy to do. All you have to do, remember, is, again, and I'm going to show you right now, if you take my color-coded chart right here, it tells us when to get in and when to get out, okay? And that's the beautiful thing about the color-coded chart, okay? It's a technology that follows the big institution money. So for our members, we have what we call Phil's 5 stocks right here, and we have our working investor stocks right here. Every day, we will post at 2 o'clock a video on every stock to tell you exactly what to do. So whether you're in the big tech ETF or you're in Goldman Sachs, you'll know exactly what to do by the color-coded chart. We tell you exactly what to do. When the short, look at this, it turns red. When the short, it turns green, when to buy it. And we tell you when to do all that. We tell you when to add to your shares. We tell you when to take your shares off. We tell you when to start shorting. And even better than that, we have a color we added, which is yellow, which gives us a warning. Look at this. When we pushed up here, it started to tell us already, it turned yellow, that the institutions were taking money out. And look how correct they were. Watch. It started to come down. So by having that turn yellow, we were warned. So my members who made all this money on the way up knew to reduce their shares, and then when it turned red, they started to sell short. So it doesn't matter anymore, okay? In other words, if you just follow the color-coded chart and do exactly what you're supposed to do, you're going to make as much money going up as the market goes down. It's a smoothing mechanism. In fact, in September is the worst month. It's the most violent month. Why? Well, the big pros, the professionals, everybody, institutions, they take their money at the end of the summer. All the money they made from January right up to the end of summer. They take it out in profits because they know they're going to be facing and that makes the market very volatile in September because they know they're coming to face October. And October, they know is the worst. That's where all the big crashes happen. So they get out in September. By getting out, okay, pulling their money out, then some people push their way back in. Like, for example, we have retail customers going in every day, think it's a great deal that the big tech stocks are dropping, Facebook and the rest of them, they're going to go in and buy it. They don't know what the hell they're doing. And we got a slew of other people coming into the market, brand new, buying the FANG stocks, don't know what they're doing. So we got a great volatility in the stock market. Well, guess what? See these 2 red lines here? That's this here, like this. Let me show you. If you take this line, right here, this yellow line, okay, right here, and take the red line, that's this one right here. It's the same thing right here, watch. Take the red line right here. We don't have to care about stocks going up and down during the day or during the week. We could care less because with what we have here is a smoothing mechanism. This is a trend, so it doesn't matter. You can wipe these all out. We don't have to even look. We don't even have to look at them. We can wipe these all out, okay? Because again, we don't have to look at the stock as long as we got the trend. We'll just stay short as long as we got the trend. Same thing on the way up. We don't even have to look at the stocks. Don't even have to look at the candlesticks. Nothing. As long as the trend's going up, we're going to make money. And we always get out before it gets to the top here, and we always get out before it gets down to the bottom here. We always trade what we call the sweet spot of the market, and this is why you're consistently making money, okay? Consistently making money because you're only trading between here. Let me show you. This is what we call the sweet spot in the market. You're always trading the sweet spot. On the way up, this is called the risk off, and then you get out here. So if you think about it, if you traded between here and here, and that's about 12%, we'll say, you don't have to get the whole thing. You just want to get between here and here, where it's the safest place in the world to make money. It's called the sweet spot. Same when you're going down here. You want to only short between here and here. So let's say you caught between, that's like between here and here. So that's between here and here. This between here and here. You don't have to get the whole thing on the way up. You don't have to get the whole thing on the way down. Each time you do that, that's a return of 8 to 15%. That's called non-risk, risk off. Has anybody ever done that for you? If you stick with the color-coded chart, do exactly what we tell you to do in the video, and you just work with us. We tell you when to get in, when to get out. You stay in the sweet spots, you'll consistently make money. And you can do this for 10 days free, and you'll see I'm not making this stuff up. This color-coded technology works, okay? 10 days, you got it free, and you got a free membership. I hope you enjoyed this. I'll keep doing updates on the market, so please subscribe and please click liking, okay? All right, see you on the charts.